Well, hello everyone. In this particular recording, we're going to go through our homework for the first of 3 non-for-profit chapters. And specifically in this chapter, we're going to talk about private nonprofits. We won't be talking about governmental nonprofits or public nonprofits. Specifically, we're going to be talking about private nonprofits. If you recall, private nonprofits are going to use FASB standards, and the most unique thing about nonprofits is we have to keep track of our contributions as either without donor restrictions, in other words, unrestricted, or with donor restrictions. And those donor restrictions can either be permanent or temporary. Now, the other thing we have to understand is the timing of when contributions are recorded. Contributions can only be recorded when they are unconditional, meaning the nonprofit doesn't need to do anything to earn that contribution. So restrictions are okay for revenue recognition purposes, but qualifications are not, right? We have to be able to, qualifications are not okay for revenue recognition purposes. So keep that in mind. So we have a simple homework example first. We need to decide whether these 8 items are either recorded as a revenue by the nonprofit, or a contribution without donor restriction, or a contribution with donor restriction, or none of the above. So number 1, a museum gift shop sold prints of famous buildings. Well, this is simply the gift shop giving up a good, selling inventory for a fee. This is regular revenue. This is not a contribution. Remember, a contribution means nothing is received in return. So that's revenue. Number 2, at the end of the year, a donor agreed to contribute $400,000 to a local artist fund if the museum raised a matching amount in the first quarter of the upcoming year. Well, this is great. There's nothing wrong with this. However, what are you reading here? You're reading that the museum has to do something first. They actually have to raise matching funds. Now, before they do that, we're not going to record this, right? This is where there is a condition. Conditions are not okay for revenue recognition purposes. Now, they're perfectly legal. This is perfectly legal. But for revenue recognition purposes, we cannot record this at this time. So the answer is none of the above. Number 3, a registered nurse volunteered 10 hours a week to a local agency for disabled persons. Okay, when it comes to a donation, not of money, but a donation of service, the FASB states that a donation of a service can be recorded as a contribution revenue if it is a service that is unique, that is something that requires specialization, and something that would have to be paid for anyway. A nurse providing nursing services is not something everybody can do. This is something that would have to probably have been purchased anyway. This is an enhanced, specialized skill. Hopefully I'm using enough language to make you understand that these specialized skills that would need to be purchased anyway is when donated services would be recorded as revenue. It's a contribution without donor restriction. It's not like the nurse said, I will service some disabled persons but not the others. Okay, so it is unrestricted, if you will, but it is a contribution. And it's going to be recorded as an expense at the same time because obviously she's utilizing her services. Okay, number 4. A donor contributed $1 million to a nonprofit for a new clinic. Okay, the donation came in, and the donation says it has to be used for a new clinic. All right, so it comes with a donor restriction. Now, it's unconditional. It doesn't say here that the nonprofit has to do something first. So we can record it as a contribution at this moment in time with donor restrictions. Number 5, a nonprofit art association hosted its annual art exhibition for the association's major contributors. Okay, all we did was host an event. Nothing is going on here. We're not receiving any revenue. We're not receiving any contributions yet. Obviously, I hope we will throughout the course of the evening, but as of now, nothing. None of the above. Number 6, a donor contributed securities valued at $10 million to be permanently invested. Remember what that word permanently means. That means we can never spend it. Earnings thereon are stipulated by the donor to be used for research. So the nonprofit doesn't need to do anything to get this contribution. So it's unconditional. That means we can record it. But it comes with donor restrictions. Some of it is a permanent restriction. Some of it is a temporary restriction. But in any event, with restrictions. So contribution with donor restrictions. Number 7, a local computer store donated computers for children's use at a non-for-profit hands-on children's museum. Well, donation of supplies, donation of assets, all right, this is a contribution, and it will be recorded at fair market value at the date of donation, okay? So basically, the computer store is saying, here are the computers, you can do whatever you want with it for children's use within the children's museum. So that's unrestricted. And lastly, number 8, a local PTA received cash contributions of $2,000 to be used for its operating activities. So operating activities basically means anything we need. So this is unrestricted or without donor restrictions is the proper terminology for contribution. All right, so that's a kind of a little warm-up exercise. Now let's take a look at, we're going to take a look at 2 types of nonprofits. All right, so the first one is pretty simple. The next one is a little bit more involved. So let's kind of get used to, and we're going to take a look at journal entries here. Here we have a soup kitchen. So the Shannon Community Kitchen provides hot meals to homeless and low-income individuals and families. It is the organization's only program. It is the policy of the community kitchen to use restricted resources for which the purpose has been met before resources without donor restrictions. The kitchen had the following revenue and expense transactions during the 2020 fiscal year. So number 1, cash donations without donor restrictions of $25,000 were received. A local philanthropist also contributed $3,000, which was to be used for the purchase of Thanksgiving dinner foodstuffs. So we got a total, we the nonprofit received a full $28,000 in cash. So if you take a look at the journal entry, debit cash for $28,000, the majority of it, $25,000, came without any restrictions whatsoever. So that is going to be considered a contribution without donor restriction. But the other $3,000 came with some restrictions. The donor says you must use this money to buy these dinner foodstuffs. All right, so it came with it's not a permanent restriction. It's not that we can never spend the money, but it comes with this temporary restriction that must be met. So they're both contributions. One's without and one's with donor restrictions. Number 2, a local grocery store provided fresh produce with a fair value of $100. The produce was immediately used. So this produce that was received, all right, whenever supplies or assets are received as a donation, it is a contribution, okay? In this case, it is a contribution without donor restrictions. We can use it for whatever we want. And because it was immediately used, you can see the debit goes to program expense. If we weren't going to use it, we were going to put it on the shelf for use at a later time, we would debit an asset called supplies. But we don't have that here. Number 3, volunteers from the local university contributed 100 hours to prepare and serve meals. The estimated fair value of their labor was $750. So once again, when it comes to donated services for a private nonprofit, the FASB states that the service has to have a specialized skill and it would need to have been purchased anyway. Well, as much as some people would like to believe, simply preparing a meal and serving the meal does not come with a specialized service, a specialized skill. Therefore, handshake, thank you very much, but no journal entry. Number 4, the kitchen received a $5,000 federal grant for the purpose of purchase of institutional kitchen appliances. Okay, so this is a grant is a gift. It is a contribution. It comes with a stipulation, a restriction. It needs to be used for a particular purpose. So the journal entry debit cash, credit a contribution with donor restrictions. And last but not least, number 5. At Thanksgiving time, the kitchen spent $4,100 on foodstuffs for preparation of the Thanksgiving dinner. Well, so the first thing was we're going to record an expense, debit the expense, credit cash. But we also have to remember, do you remember way back up here in number 1, the philanthropist contributed $3,000 for these dinner foodstuffs? Well, I don't know if you remember, but when we read the original instructions, it says the policy of the kitchen is to use restricted resources first before unrestricted resources. So when we spend the $4,100, that means the first $3,000 comes from the restricted resources. And because those restricted resources have been used to fulfill the purpose of the restriction, what we're going to do is we are going to release those restrictions. And the reason we do that is because the operating statement really has 2 columns. It's really like 2 income statements in one. We've got a column for basically without donor restrictions and a column for with donor restrictions. Well, when the restriction has been met, we literally move it or transfer from one column to the other. And we do that in the form of a journal entry. It's backed up with this journal entry. And if we take a look at journal entry 5B, we can see that we're going to record an account called net assets released dash with donor restrictions. That's a debit. And debits reduce the revenue, right? Reduce the revenue on the operating statement. And then we credit net assets released dash without restrictions. So that column, the without restrictions, the credit is going to make that revenue section increase. Okay, it's a swap. These are accounts on the operating statement, just like revenue and expense accounts. These net asset released accounts work the same way. Debits will reduce and credits will increase. And now let me show you a longer problem, and I'm going to show you the resulting financial statements after these 11 journal entries. So we have a new nonprofit involved. They were incorporated as a non-for-profit voluntary health and welfare organization on January 1, 2020, and for the first fiscal year ending December 31st, 2020, we have our journal entry. So let's take a look at number 1. A business donated rent-free office space to the organization that would normally rent for $35,000 a year. So basically a landlord is giving the nonprofit free rent. This is a donation. This is a contribution. And that contribution would be recorded as follows. Debit rent expense. We still have the expense, but instead of paying it in cash, it's being covered by a contribution. So we're going to say it's a contribution without donor restriction. I mean, we can simply, it's not like it's restricted in being spent in a certain way. That's not the case here. So without donor restriction. Number 2, there's a lot going on here. So let's read this and make sure we understand it. A fund drive raised $185,000 in cash, as well as $100,000 in pledges that will be paid within 1 year. As you recall, I hope you recall, let me refresh your memory, a pledge simply means a promise to give. And if it's an unconditional promise to give, we're going to record it as a contribution. If it's a conditional promise to give, we won't record it just yet. Okay, a state government grant of $150,000 was received for program operating costs related to public health education. I need you to remember that, public health education, because it's going to come into play a little bit later on in this homework problem. All right, so what did we receive? We received $185,000 in cash, $100,000 in pledges, as well as a government grant of $150,000. Well, if we add up the cash, That's the 150 grant and 185,000 in cash. Total cash of 335,000. And the other 100,000 is an unconditional promise to give. That is a contribution receivable. That's the pledge. So out of the 435,000 that we've effectively received, the only thing that came without donor restrictions are basically the 185 in cash. 185 in cash, came without restrictions. I didn't read anything, so we're going to credit contributions without donor restrictions for 185. The other 250 came with donor restrictions. Well, that's the 100,000 in pledge and 150 in the state grant. Well, the state grant has a use restriction. It must be used for public health education. But the 100,000 in pledges comes with the restriction. It doesn't come with a use restriction, but it comes with a time restriction. And basically what happens is if the money is not going to be received within the fiscal year, it's restricted as to time, not as to use. So between the 100,000 time restriction and the 150,000 use restriction, a total of 250,000 is a contribution with donor restrictions. All right, that was probably one of the more difficult ones, but the rest are hopefully pretty straightforward. Number 3, salaries and fringe benefits, 208,560 plus an additional 16,000 of salary and fringe benefits are accrued at the end of the year. So adding the two numbers up, we'll debit the salaries and benefits expense for 224,000. 208,000 of it is paid in cash, so we'll credit cash, and the other 16,000 is a liability at the end of the year. It's accrued. Number 4, a donor pledged $100,000 for construction of a new building, payable over 5 fiscal years, commencing in 2022. The discounted value of the pledge is expected to be $94,260. So when a donation comes in and it's unconditional, but it's not going to be paid until a number of years into the future. Now remember, where are we? We're basically in the fiscal year ending December 31, 2020. Well, when are we going to receive this pledge? Over 5 years starting in 2022. So that's 2022, 23, 24, 25, 26. Well, when you're in the year 2020 and you're looking out to the year 2026, that's a long time. And so whenever we receive an unconditional pledge to be received over a number of years, we have to discount that future contribution to its present value. And I'm not going to ask you for purposes of this class to try to figure out present values. I'll actually tell you what the present value is, as I did in this homework question. The present value is $94,260, and the receivable is $100,000. So the journal entry is as follows. We'll debit the receivable for the full gross amount of $100,000, but we can only credit contributions with donor restrictions. There's a time restriction here for $94,260. This is the discounted amount. The difference between the discounted amount and the full amount, the future value, is going to be credited to discount on contributions receivable. This is a contra receivable. This discount will be amortized into revenue over the years when it's collected. Okay, number 5. Office equipment was donated, and some office equipment was purchased. Office equipment was purchased for $12,000, had a useful life of 5 years, and office furniture with a fair value of $9,600 was donated by a local office supply, had an estimated useful life of 10 years. Furniture and equipment are considered net assets without donor restrictions by involved. So when the nonprofit receives the equipment and furniture for a total of $21,600, $12,000 of it was purchased in cash, so we'll credit cash. The other $9,600 was donated. and it's going to come in without donor restrictions, meaning we can use the fixed asset, the equipment, however we want. Credit contributions without donor restrictions. Number 6. So basically we've got a whole bunch of payments. Telephone expense $5,200, printing and postage $12,000, utilities $8,300, supplies $4,300. And at the end of the year, an immaterial amount of supplies remained on hand, and the balance in accounts payable was $3,600. Basically what we're saying here is, here are the expenses incurred for the year. They were all paid for except for $3,600. So you're going to see the journal entry. We're going to debit all of the various expenses. We're going to credit cash for all of it except $3,600 was accrued as accounts payable because it was unpaid at the end of the year. Number 7, volunteers contributed $15,000 of time to help with answering the phones, mailing materials, and various other clerical activities. And because this is not a specialized skill, the FASB says that we do not record the contribution of services. If it was a specialized skill, we would. Number 8, it's estimated that 90% of the pledges made for the 2021 year will be collected, and depreciation expenses also recorded on those fixed assets we received back up in number 5. So if we come back up to the pledges, where was it? It was in number 2. Do you remember this? We received $100,000 in pledges. Well, 90% or 90,000 of it is expected to be collected. That means 10,000 is not going to be collected. So what we need to do is basically increase our allowance for doubtful accounts. We will debit provision for uncollectible pledges. That's an expense, like a bad debt expense, and we will credit the allowance for uncollectible pledges. In addition, we're going to record the depreciation expense. I won't go back and do the math, but we're going to use straight line depreciation. Some of those assets were a 5-year life, some were a 10-year life, but it works out to $3,360. Debit depreciation expense, credit accumulated depreciation or allowance for depreciation, same thing. And number 9, what we're going to do is we're going to break up our expenses into the different categories of how we're going to present it on the operating statement. Remember, with nonprofits, we need to break up our expenses into basic categories. Basically, supporting services, and the other one is we're going to see supporting services, and the others are program services. So the author is saying that all of the expenses are broken down as follows. Public health education, 35%. Community service, 30%. Management in general, 20%. And fundraising, 15%. The best way to do this is prepare a table that looks something like this. Now, what we saw in all of these 1 through 8 transactions, if you go back up and you look at all the expenses, these are the amounts we came to. Salaries and benefits was $224,000. The rent, you remember that? $35,000. The telephone, the printing. Anyway, all of these expenses we actually went through in journal entries 1 through 8. And so we're going to break them up in the allocation percentages as was stated here. So public health education, when we take the $224,560, and let me just go back up to see it again. Public health education was 35%. So if we take 35% of this $224,560, we're going to get $78,596. Community service was 30%. Management in general was 20%. And fundraising was 15%. Okay? So we're going to do that across the board. And when we do it across the board, we see public health education is now $105,952. Community service, $90,816. Management in general, $60,544. And lastly, fundraising, $45,408. So if we take those numbers, those are our new expenses, and we have them listed here. Public health, community service, management in general, and fundraising. And what we'll do is we'll get rid of all of the other expense categories with credits. Now, do you remember I said earlier, remember this, public health education? You remember that? Let me come all the way back up so we can remember. Remember we got a state grant for $150,000 for costs related to public health education. Well, that $150,000 grant was originally recorded as a contribution with a donor restriction. Well, we spent most of that $150,000 already. How much did we spend on public health education? Here it is, $105,000. So that $105,000, basically the restriction has been released. So the journal entry would be as follows: debit net assets released dash with donor restriction. So that goes down. And then we will credit net assets released dash without donor restriction. That category goes up. All right, and I'm going to show you the financial statements in a few moments. All right, and then last but not least, number 11, we're basically saying all the nominal accounts were closed. So we're basically closing all of the operating statement accounts. And we will do so as follows. We will get rid of we'll close out the contributions without donor restrictions with a debit, close out all of our expenses with credits, and whatever is needed, debit or credit, to balance the journal entry. Net assets, that's the equity. Equity for private nonprofits is called net assets, $73,000. Now, the other closing entry, we'll close out contributions with donor restrictions. They'll get closed out with debits, closed out directly to net assets with donor restrictions. And then lastly, those net asset released accounts. Net assets released dash with donor restrictions had a debit balance, so I'll close it with a credit, and it'll close out directly to net assets with donor restrictions. And lastly, net assets released without donor restrictions had a credit balance, so I'll close it with a debit, and I'll close it out directly to the net asset without donor restriction account. After all of those journal entries, here are our financial statements. The first one is the operating statement, known as a statement of activities. And as I've been explaining all along, it comes with two columns. One column without donor restriction and another column with donor restriction. And I wanted to point out two things. First, you remember this account that we used, net assets released from restrictions? All right, with donor restriction, that was debited. That's why it's a negative number. Without donor restriction, we credited that account. So it's a positive number. It's adding to the revenue account. And the other thing I wanted to show you is that all expenses are reported in the without donor restriction column. We never ever have expenses in the with donor restriction column. All right, so if we take a look at revenue less the expenses, that gives you your increase in net assets. Because it is a brand new nonprofit, we can say beginning net assets are 0. They add the 0 to the increase in net assets, you get ending net assets, $32,000 for without donor restrictions and $238,000 with donor restrictions. Remember these numbers because they're going to be on our balance sheet, which is here, and there they are in the net asset section. And then of course you have your assets and liabilities. So there's a lot of moving parts here, and hopefully that is understandable to you. And here's a cash flow statement. Nonprofits have a choice. You can use the direct or the indirect method. Here you can see the author has decided to prepare a direct method cash flow statement.